Hey, how's it, everyone? Thanks for tuning in on this beautiful Tuesday morning. The big question is the US dollar index going to break down or what? And why should we care? Now, if it does, the dollar index, DXY, starts to print fresh year-to-date lows, we're most likely in the early stages or in the midst of a rip-roaring rally for risk assets. Think SPY, the SP 500 back above 4,200. So with that in mind, let's check in on the dollar index, highlight some key levels, look beneath the surface more broadly, and then check in on a critical intermarket relationship that's really been driving the markets for the past year and a half. Let's dig in. Here we have a daily chart of the US dollar index going back about a year and a half. Now, 101 is the level. Those are the early year-to-date lows, say early February lows, where price dug in, or excuse me, the dollar index dug in, found support, and that's where we are today. Now, dollars has jumped a little bit in the past couple days, and we want to see a breakdown below that level to support or suggest further risk-seeking behavior for investors. Now, on the upside, that 105 level, that's really been that's been the ceiling for the dollar over the past 4 months or so. For now, it remains range bound, and it makes sense as long as the dollar remains range bound that risk assets continue to chop sideways. Again, I'm speaking more broadly. Think of S&P 500. Imagine as long as the dollar index is above 101, S&P 500 is most likely below 4,200. Now, in the event that the dollar does begin to break down, even we get DXY below 101, I'm looking for an RSI reading, a 14-day RSI reading below 30 for confirmation. Now, that's something we've yet to see since the dollar index peaked back in late September of last year. Even after that steep decline of violating that parabolic trend line last fall, bears have yet to take control of the market. Now, if and when they do, I imagine the DXY is below 101, that would signal that it or just increase the likelihood of further downside action. However, when we look beneath the surface, when we look at our G10 currency, I should say beneath the surface, when we look more broadly, when we look at the bigger picture, go beyond those 6 components of the dollar index, we're not seeing similar signs of near-term weakness. While the dollar index in the top pane here down and retested its year-to-date lows, G10 currency index has not, and neither has the US dollar AD line. It's composed of $29 pairs. So we're getting a lot of the emerging market, which we have seen some strength there for emerging market currencies. Yet this AD line, again, not following the same path of the US dollar index. Again, if and when the US dollar index breaks to fresh lows, expect the G10 currency index and this AD line to follow. So as long as they remain buoyant, as long as they're holding above their year-to-date lows, any breakdown, any weakness in the dollar index, I view with suspicion. Right? Another point, another clue that I'm monitoring. Give me direction, or give me an idea, insight into the next direction of the US dollar index, next major move, yields. Right? The yields in the US dollar index have had an extremely strong correlation, positive correlation over the last year and a half. See, it really started to kick in here. In the lower pane, we have a 126-day rolling correlation. Really started to kick in the fall of 2021, and it remains intact. So as long as rates remain elevated, which they do, as long as they hold above their year-to-date lows and the June pivot highs, from last year. I imagine the US dollar index is holding above its year-to-date lows as well. However, again, if the dollar does break down to fresh lows, if it does begin to roll over, I'm looking to yields to confirm the breakdown. Rates aren't rolling over. I highly doubt the dollar index is going to be rolling over. Right? These are things to keep in mind. Again, why do we care about what the dollar does? Well, the dollar's the catalyst, and so are rates. And they've been driving the markets again for over a year now. So if risk assets, both commodities and stocks, are going to turn it around and begin to catch higher, they're going to do so in an environment where rates are declining and the dollar is printing fresh lows. So these are charts you want to keep in mind. Also keep in mind what are we seeing here beneath the surface, right? Check in with our AD line, check in with our G10 currency index. And again, keep in mind that we need to see the bears take control. Again, just so these keep on your radar as we see more and more investors begin to reach for risk. Again, if the dollar's printing fresh lows, investors are most likely being rewarded. Thanks for watching, everybody. I will see you tomorrow. Take care.